The Federal Reserve has been in the limelight for the last 3 years, and it hasn't gone as Powell would have hoped. He has not been declared the savior of the economy. He has not been declared master of coin and the greatest monetarist to ever exist. In fact, he's been declared an utter failure because the state of things today are undoubtedly poor. The Fed is on the brink of bankruptcy itself, with its own balance sheet getting more and more negative, and at the exact same time, the Fed is also busy bankrupting the global economy, driving us all on a one-way trip down into a depression. But the craziest thing about all this is that no one even knows what's really going on or how to protect their investments during this crazy time. So if you're interested in saving and protecting your wealth, watch this entire video. Now, many people don't know this, but the Federal Reserve claims to have just two mandates: to maintain price stability or just keep inflation low, but also to keep the job market strong and Americans employed. But there is also another secret mandate of the Federal Reserve that no one talks about, and that is to make money. Yes, they print money, but they also try to make a profit. And actually, the Federal Reserve has been making a profit since about 2011 thanks to asset prices rising across the board. Yes, the Fed, the backbone of the global economy, actually exists in part to make money, and this is not news. This has been the case for years now. But over the last few months, things have changed, and the Fed has been losing money, not making money. You see, the profits that they do make, they have to send them on over to the US Treasury, but for years, and over the last few years, they'd sent back roughly $2 billion. But things started to change as 2022 ended and the monetary environment took a dive. Suddenly, no longer has the Fed made $2 billion, but they've lost $20 billion instead. And how is this happening? Well, this comes back to the exact same cause of the banking crisis that we've just seen in the United States. The Federal Reserve owns trillions of dollars of assets like mortgage-backed securities and treasuries, but the values of these bonds have been dropping in price steadily over the last year, so now the Fed is sitting on trillions of dollars of paper losses. Now, that's not a problem as long as the Fed doesn't sell those assets, but selling those assets is exactly what the Fed has been doing in an attempt to lower the levels of inflation in the economy. The Fed has been selling these assets, reducing the size of the money supply. They've been tightening the economy. They've started quantitative tightening, but this means they are realizing those losses on these assets. They bought them for a certain amount of dollars, and now they're selling them for far below those levels, leading to real losses of $20 billion. If the Fed continues with quantitative tightening, if they continue to sell their assets at a loss, they will find themselves insolvent, as every time they sell these assets, they reduce their value even further. And if the Fed decides to go in the other direction and print more money and buy up more assets, they only increase their exposure to these falling asset prices, making them even more insolvent in the long run. And what did the Fed do last month? That's right, they printed $300 billion to try and end the banking crisis, pushing them further into the red. Thankfully, you might say, the Fed has an accounting gimmick built into the law that allows them to hide these problems, and it's called deferred assets. And while this stops them from having to admit to these problems, it doesn't make the problems go away. The way this works is the Fed basically give themselves an IOU for future profits that they are expecting to make just based on the fact that they need some kind of asset to stop their balance sheet going negative. That's right, they're literally creating future profits out of thin air and recording them down on their balance sheet, just like Enron did 2 decades ago, which led to the greatest corporate fraud in the history of the United States. The only difference this time is that this fraud is being committed by one of the most entrenched governmental organizations the world has ever seen, and unfortunately, just like how the banks not having to mark their bond losses down as real losses didn't actually stop the problem from existing, it just lets them pretend that it doesn't exist. Now, some people will say that $20 billion in losses is pennies compared to the Fed's balance sheet that sits at over $8 trillion, so what's the big deal? Well, the balance sheet isn't what's important here. What's actually important is the Fed's equity, and on that front, things are really not looking so good. Currently, the Fed's equity sits at about $28 billion, and the Fed has already lost about $20 billion over the last 9 months or so of quantitative tightening. Now, it doesn't take a genius to understand that this is a much bigger threat, and that if things continue on in this fashion, that the Fed will find itself insolvent as a result of these massive losses that they just keep on booking. Now, to the average Joe who doesn't watch this channel, who doesn't even know what quantitative tightening is, this all flies right over their heads. It works. The Fed is allowed to do whatever they want without having to answer to anyone, but it just hides their problems. It doesn't fix them. It just brushes them under the bed to be dealt with by someone else. Now, the Fed was already in an uncertain place about their path forward, and this escalating bond crisis means even more volatility in markets and possibly even more banking collapses. After SVB, even Ken Griffin said that US capitalism itself was breaking down before our eyes, and now JP Morgan says the S&P 500 could sink another 20% as the economy is pushed to the brink. No wonder nearly 90% of financial advisors are going big into alternative investments in just the next 2 years as a way to reduce volatility. Morgan Stanley just released a report on alts, and as their graph shows, for the last 30 years, a portfolio that included alternative assets would have had lower volatility and higher returns. This alt playbook is spreading rapidly according to the Financial Times, but Bank of America's investment head and BlackRock's Larry Fink have both recommended one specific high-performing alternative to rescue your cash: fine art. Don't believe me? Last year, art prices rose by an average of 29%, and Masterworks returned over $25 million to their investors, including many of my viewers. I've talked about Masterworks for over a year now, and literally hundreds of you have already signed up to diversify and lower your own volatility. You see, Masterworks offer art from legends like Picasso, which is securitized with the SEC and broken into shares. In December, Masterworks' last 3 exits delivered 10, 13, and 35% net returns to investors like you, and at the end of March, they sold another piece for a 15.4% realized profit for their investors, even as we were in the brinks of a banking collapse. But it's not just that recent exit. Each of Masterworks' 12 sales to date has returned a net profit in excess of 9%, all the way up to 39% for a George Condo piece. As a result, paintings can sell out in hours, not days, but right now you can get priority access to skip the wait below. And as for the state of the Fed, the only problem isn't just the Fed's solvency, it's everyone else's as well, because the economy is heading down, and right now, the only question is whether we're in store for a recession or a depression. The Fed allowed for this inflationary environment to take hold by printing money every time the economy coughed over the last 15 years, and that is finally starting to bite back. Inflation is still far too high despite what those Tesla-obsessed YouTubers will tell you, and it isn't going down nearly fast enough. Right now, CPI in the US is sitting at 5%, and we're being told that this is good news. CPI is 2.5 times what the target is, and at this rate it's going to take another full year minimum for it to finally get down to the desired level of 2%, and that is after a frankly brilliant monthly reading for March, which saw headline year-over-year CPI figures drop 0.2% lower than economists were expecting. But excluding food and energy prices, looking at the number that the Fed themselves say are the most important ones, prices still rose by 0.4% over just 1 month, which annualized is just under 5%. If prices had stopped rising altogether and the yearly CPI figures that we keep getting through were just leftovers from the prior year when there was still an energy crisis and interest rates were still at 0%, then maybe there would be an argument to be made that inflation is a done deal, that it's dealt with and a non-issue, but that is not the case. Interest rates have been hiked by 5% and inflation is still giving us monthly annualized readings of 5%. This means the Fed has a long ways to go to fight inflation, and that means interest rate hikes are going to keep coming up month after month after month. And what has been the result of these hikes so far? A banking crisis that gave us 2 of the largest American banking collapses ever seen in history, and many more banks would have collapsed if the Treasury hadn't essentially promised to bail out every single bank in America if they had to. Now, who listens to these facts and thinks that this is a stable economy looking like it's about to boom? Who sees with their own eyes the turmoil in the banking industry explode out of what seemed like nowhere, followed by a bailout to the tune of $300 billion, and then just 1 month on believes the media when they say that all is well and there's nothing to worry about? The media have been wrong about the economy time after time after time for the entirety of the last 3 years, and now we're suddenly expecting them to get it right all of a sudden, even when they're pushing the exact same lines today that they pushed over the last 3 years? The simple fact is that none of this makes sense. The Fed has to keep hiking interest rates because the economy is still too hot, and the job market, while it has been impacted slightly, has not been damaged to a sufficient extent to defeat inflation. That means the Fed is going to hike until the job market breaks, or as we saw over a month ago, something else breaks instead. Will it be the exact same problem with the exact same banks that breaks this time round? No, it will not, because that problem has now been realized by the banks and the Fed, but there will be another problem that rears its ugly head and threatens to tear everything down. The Fed will once again have to make a decision like they did with the banking crisis just gone. That time they chose to print $300 billion over the course of a single week in order to bail out those banks and keep them solvent and not throw the country's economy into an instant collapse. That leads me to believe that when the next crisis comes, they will do something similar and choose instant stability over long-term stability. In all likelihood, that means inflation remaining high for years to come as Powell becomes the very thing he's been so terrified of becoming over the last year, a failed Federal Reserve chairman who has to vacate his position to allow a Volcker to come in and save the day. But even that savior comes with a cost, and an incredibly painful one at that. A sustained long recession that damages everyone and everything and takes years to emerge from without the assistance of money printing. That is not something any of us should look forward to under normal circumstances, but it is the only possibility for exiting this cycle of crises and inflation over the long term. It's the only real solution. If you're fed up with being lied to by the media about this whole ordeal, if you want to finally take back control from your investments and perform the best for you, then subscribe to my channel, watch other videos, and sign up for my 100% free email newsletter Stoic Markets. It gives you all this vital information without the threat of YouTube censorship, and a few days before this video went out, I actually sent an email out to those subscribers telling them exactly what was going on just in advance of this YouTube video. If you want to look at alternative assets to protect your investments like fine art, then check out this video's sponsor Masterworks, or if you just want to find out how Blackstone is on the brink of collapse, then watch this video here.